This Week in Startups is brought to you by LinkedIn Jobs. A business is only as strong as its people, and every hire matters. Get $50 off your first job post at linkedin.com/twist. ChartHop. Growing your company is hard. Planning for it doesn't have to be. Visualize your company's future in seconds with ChartHop. Get $600 in credits, which will cover your first 5 employees, by signing up at charthop.com/twist today. And Gusto. Running a startup is hard work, but thankfully Gusto makes payroll easy. They also offer flexible benefits, onboarding, and so much more. Twist listeners get 3 months free at gusto.com/twist.
All right, everybody, welcome to This Week in Startups. It has been a crazy week, month, and year, obviously, not only because of the pandemic and the election, but because we have so many companies that are going public. And this is a complete 180-degree change from what we've seen over the past decade, where founders were taking the horrible advice to stay private longer so they didn't have to deal with reality, scrutiny, and they continued to receive just incredible amounts of funding with very little governance. And that can get you into trouble, as we've seen with WeWork and Uber and other companies that in some cases blew up like WeWork, in other cases had a rocky road to their IPO. But today, at the taping of this on December 10th, 2020, we have 2 huge IPOs that have occurred this week, both DoorDash and Airbnb, and the results have been absolutely stunning. With me to discuss these issues and more, Alex Wilhelm of the Equity Podcast over at TechCrunch, senior editor at TechCrunch, calling in from somewhere in the Northeast.
That's correct. Providence, actually, where it's not warm. So I'm here from the frozen Arctic, is what it feels like.
And how is the pandemic spike in Rhode Island? Is there one?
It's bad. Yeah, we're among the worst in the nation on a per capita basis. So my wife hasn't let me out of the house in a couple weeks. And so that's not going to change until probably June. So I'll be literally in this chair until Q3. So that's exciting.
Crazy. Well, stay safe. And yeah, when it gets cold, everybody's forced to go inside. And then everybody decided to YOLO for Thanksgiving. And here we are, literally in the final inning of the game.
Yes.
And people decided, like, I don't know what analogy to use, but I was talking to a friend of mine. I was like, this is like dying on the way back from a war. Like, we know the vaccines work. They're coming literally tomorrow or next week.
Yep. And
the war ends and people start dancing in a minefield on the way back to the boats. And it's like, no, wait till you get back to shore to dance. Like, don't get yourself killed. We'll stay safe, obviously. Beth Kindig is with us. She is Beth_Kindig on the Twitter, and she is a tech stock analyst with the newsletter Beth.Technology. Nice use of the new top-level domain names. Beth, welcome to the program for your first appearance.
Thank you.
So let's start, Beth, with what we saw today. Airbnb made it out, and DoorDash was yesterday. Both of them essentially doubled. And so Bill Gurley is probably having an absolute meltdown right now that these were underpriced, and there was massive demand for these 2 companies. Maybe what are your initial thoughts on this unbelievable spike? I mean, I don't think anybody thought Airbnb would be getting close to $100 billion or DoorDash would be worth $40 billion. These are crazy valuations for these companies. What are your thoughts?
Yeah, I think there's always a lot of risk when everything's been priced in, and a lot of consumers, a lot of investors on the public markets, they use DoorDash, they use Airbnb, they're very familiar with the names. So I think it's been fully priced. What we really try to do is we try to find opportunities that maybe are lesser known. So I would say the bigger news for us this week was Luminar, which is a LiDAR company that's partnered with Mobileye and Volvo. And then we also really like C3, which is enterprise AI. We think that they could, really eat a lot of market share in the future. And these are not as talked about. So for us, DoorDash and Airbnb came out the gate, and they are certainly fully priced, I think, at this point. So there's a lot of risk because when we've done a ton of analysis, we use our own money for this with our fund. The large majority is in almost every single stock. trades at its opening price again after the lockup period. So you see this initial excitement the first 6 months, employees and insiders and whatnot can't sell their shares. And then after 6 months, the lockup expires and you start to see it return back to an opening price. We've seen this with super strong stocks. CrowdStrike was, immaculate. And so was Zoom Video on their S1 filings. And when they came out the gate, it shot up, but after the lockup period, they both went either at IPO opening or below. So that's just some of the things we always try to give an edge, and we try not to get too exuberant over these big names, but certainly, they both clearly have a big addressable market. So,
and when you mention those sort of retail investors, people who love the products themselves, that was like the original, I forgot the guy who was, wrote some of those Beat the Market books, but his basic premise was buy what you know. Like if you love Disneyland, go to Disneyland. If you love the Gap, buy the Gap. Well, here we are, Robinhood traders, there's some number of them, 15 million of them or something like that in the market. Alex, I'm curious your thoughts on how much of DoorDash and Airbnb have to do with retail investors who are new to the market, who are putting in orders maybe without a price on them. And they just say, I want to own this because, stonks, as the meme says, go up.
So one thing that I learned over the summer, I was talking to, I think it was the CEO of Lemonade after they went public in June, July, whatever it was. And I was just riffing with him because they also had a very good first day. And I was like, good job. But also, what the heck is going on? And he emphasized the importance of brand to me. And, as a person who opens an S1 and scrolls past all the words to the income statement immediately because I don't want to hear your hype, I just want to see the results. I was very perplexed by this, but I really think the brand point resonates with the investors you're talking about. I think the Robinhood crew do want to own shares in companies they know. I think that the difference between this and those old books you were talking about is the number of investors out there that are willing to make bets is much larger. And I don't think the float of any of these IPOs has gotten much larger. So we're seeing probably a greater imbalance in supply and demand in these early couple of trades. So I'm very sympathetic to what Beth said about let's see where we are in 6 months. I don't think these companies left 50% of the value on the table. I think they're just artificially inflated in the short term. So a great first day, but I don't think it's inherent that their value has gone up this much in such a short period of time.
And neither of these were direct listings. If they had been direct listings, then there would not be a lockup, correct, Beth?
Correct. And we've actually been, Slack and Shopify both were, Spotify. Sorry about that. Spotify and Slack, they were both direct listings and they did not perform that well. I mean, we were Slack investors. We actually got in pretty low during the March sell-off. So certainly happy to see what happened recently, but it took a long time. You really had to stick it out with Slack and Spotify as well. I believe they opened around 185 and it was back down to 120. And it took a long time for them to break the 185 again with the direct listing. I think that liquidity in the beginning can really weaken the strength of the stock. I prefer lockup periods for everyone involved.
So you prefer the lockup so that you don't have a rush to the exits.
Right.
But you still have a rush to the exits in that 6 to 12 month period. So I guess the counter argument would be, why not allow just everybody to take the medicine early and kind of get to the ground truth quicker?
There's something I think that builds confidence when the stock doesn't immediately plummet like right out the gate. And the other thing is there's more price action to analyze. So most of the market is run on machines. There's a lot of technical analysts out there. Goldman Sachs is not just buying great companies. They're looking at the technicals and the price action. So when you have more history, you can determine a little bit better as to where the stock price is going to go.
So just looking at these numbers today and putting them into a little bit of context, DoorDash has a $59 billion market cap with $1.9 billion in revenue. So that would be 30 plus times top line revenue for 2020. Forget about earnings on these for a moment. Airbnb is over 100 or was over 100 today in terms of the market cap with $2.52 billion through the first 3 quarters. So if we were to add another, whatever that is, 800 million, you'd be at 3.5. So that would be 33 times. So they're both trading somewhere in the 30x top line revenue. That's a bit
bonkers.
Disconcerting. Yes, Alex?
I mean, look, I think we've all become more and more accustomed to high SaaS revenue multiples because SaaS revenue expands over time. It's highly durable and incredibly high gross margin. Cool. Not Every company deserves a SaaS-like multiple, let alone a rich SaaS-like multiple. DoorDash is currently valued like a software company that's in the top 5 software companies in the world. It doesn't have the same gross margins. It doesn't have the same proven revenue repeatability. And you know what? It's coming to this IPO off the back of a very impressive year. To be totally honest, they've done amazingly well, but there's a lot of question marks about what happens to their sales growth when the pandemic ends and we can all go outside again. So, I look at this valuation and I'm very excited for DoorDash and the investors and the founders and the employees. It's great. Good job. But, I think when Beth said fully priced in, I think she was being a little bit modest. I think it's actually probably just flat out overvalued at this price. I see no real reason for it.
Beth, is there a price if you were to put a multiple on these two specific companies, just 10x, 20x revenue, that they would become attractive to you? If right now they're 30 and change times top line revenue, what number would be attractive to you? What would be tolerable to you? 2 numbers.
Yeah, so I'll buy the 30x if I know that they're going to be growing 60% to 100% the following year. And the problem that we're reaching with Airbnb, DoorDash, and some of the ones that I'm even invested in is that they're going to be harder comps, basically. And so the institutions and the analysts, they all kind of know that. So you're seeing a little bit of a cooling off with any of these stocks that were able to put up triple digit growth. You're seeing like Shopify, Zoom Video, a lot of these Datadog. You're seeing them cool off because the analysts just don't know how to gauge the harder comps next year. When you've grown 100%, 300%, can you multiply on that larger revenue base? So it's all about the forward. I will buy a 30x company, but I think we're in a period of time where it's more risky than ever before to buy 30x tailwinds from COVID companies. And then the 20x is actually pretty comfortable for me if it's in the 55% or higher revenue growth range year over year.
All right, when we get back from this quick break, I want to talk a little bit about what we saw from Zoom specifically and what we think will happen going forward. And if the Slack exit, if we can infer something from what's happening in the market, if those investors and management team wanted to take the cash and run with it as opposed to try to stay independent, which they probably could have done, but it seems to me that maybe that's a bit of a tell of where the market is heading when we get back on This Week in Startups. Okay, snowmen and ugly sweaters, some things about the holiday season will never change, even when everything around us has. So when your small business needs to ramp up for the new year, and you're probably doing your planning just like I am right now, you're going to need to hire the right people quickly to execute on your plans, and LinkedIn Jobs is here to help. LinkedIn Jobs matches your open roles with qualified candidates, which means you can find the right person for your business fast. Ugly sweaters are not included. Getting started with LinkedIn Jobs is easier than ever. And since LinkedIn has over 722 million members worldwide, you can start finding those qualified candidates fast. You can manage these job posts right inside of the familiar LinkedIn.com interface. And you get all of the functionality streamlined into one simple screen. And you can do it all from your mobile phone, right? Jay Berkowitz from 10 Golden Rules, which is a boutique digital marketing agency, used LinkedIn, and he told us this story. He's a fan of the pod. And he was looking for an account manager because his business is booming. And he got over 150 great applications, identified his 2 targets that he wanted to pursue. And it turned out they had mutual connections, right? He hired his favorite candidate and they've worked out great so far. So when your business is ready to make that next hire, find the right person with LinkedIn Jobs. You can pay what you want and get the first $50 off right now at linkedin.com/twist. That's right. Get a 50 off your first job posting. Terms and conditions do apply, because you're going to get the $50 by going to linkedin.com/TWIST. All right, welcome back. Beth Kindig is here. She is a tech stock analyst. She invests her own money, correct?
Correct. We have a fund. Yep.
You have a fund. And so you are literally making bets, and you can read her newsletter at beth.technology. She contributes to Forbes, MarketWatch, Fox, and other news platforms. But let's face it, everybody's going direct these days. Alex Wilhelm has been on the podcast so many times I can't even count them. And he is a senior editor of TechCrunch and does their equity podcast. And I mean, you're basically the guy who dives into the S1s when they get published. And so life has been a bit crazy. More S1s in the last month than probably the last 10 years, right?
Yeah. I joke that it's better to be busy than bored. but I think we've really stretched that to the max. And on the, being the person who dives into the S1s, most people don't like to do that. I happen to be a freak in that I enjoy reading them. So that's all landed in my lap because it's not, drudgery. So yeah, I do it.
Yeah. And do you have a favorite section you like to go to? Just the balance sheet, just the revenue?
I like to go there first, and then I like to do second. I like to go fiddle around with their non-GAAP metrics and try to figure out what they're doing to lie to me. Because every company has their own warped view of reality about what's actually fair for their business, and it's always complete crap. And if it's a SaaS company, go read the net dollar retention section and figure out how they're making the numbers look better than they actually are. It's always fun to see how they're trying to get around the truth.
So there's a little bit of accounting that goes on that could be creative. In this GAAP accounting. Give us an example of, something egregious, something reasonable, something maybe conservative, or in that range when you're looking at how they do their accounting in relation to this, let's say the last 2 years of public companies.
Yeah, I think we've seen more companies begin to report stats that we tend to throw around in the startup world, like ARR. If you go back a couple of years, I think it was harder to get ARR written down on your S1. But companies now like CrowdStrike, which we'll get to later on, now both report, GAAP revenue and also ARR growth in their earnings. So it's become a bit more standard. And I'm totally comfortable with that, neutral about it. What I don't like, for example, that I think is too loose is when companies discount lost customers and then only discuss net revenue retention of customers that didn't churn, because you're just deleting the bad news and only keeping the good news and claiming that you're giving me real numbers, which is, bad. And
so
then,
to translate that for people who haven't heard these terms, annual reoccurring revenue would be
ARR.
If you are Slack and people are paying whatever it is, $100 per seat, and you've got 1 million people, you've got $100 million in ARR. But what you're saying is if 10% of those were to churn and now you're down to whatever it is, 900,000 members, the net retention of the existing people who are still using the product is kind of intellectually dishonest because you really want to include the people who churned.
Yeah. So let's say, you have 100 customers and, 90 of them pay you $110 next year, not 100. And then you tell me your net revenue retention is 110% because you've not counted the customers that churned. To me, you're being disingenuous. And we see a lot of companies try to take what I think are startup-ish metrics and bring them into the public world, back to your point about going public being important for scrutiny. And that always makes me a little bit mad. If you're a seed stage startup, we'll talk about the idea. If you're a Series C, I want to know about gross margin improvements. And if you're going public, I want GAAP numbers, So the standards get higher as you get older as a company. I just like to see just straight up GAAP stuff. I mean, it's standard for a reason. It's good.
Yeah. And for those people who don't know, generally accepted accounting principles, which are a bit of a moving target because they do change over time. And then people do lobby to change them. I remember back in the day, AOL was trying to say their $300 acquisition price could be spent over 10 years or something. And they got themselves in all kinds of trouble with those creative moments. Beth, what are you seeing in terms of creativity in accounting now that would either be a red flag or, maybe even an opportunity where, some group of people are being conservative and their companies are getting dinged for it?
Yeah, I guess I'll take the opportunity to talk about one of my pet peeves is when, Snowflake is an awesome product, and I absolutely think the management is incredible. It's only 6 years old, and so when you look at the growth rates, people will say we've never seen any tech company have these growth rates, which isn't actually true because if you adjust many of the other companies that have gone public, that went public in their 8th year, 9th year, whatever, 10th year even, they were growing at the same rate as Snowflake is now, or even higher. So that's one thing that kind of is a little bit of a pet peeve of mine because, Jason, I know you know this, and Alex, you too, like startups, tech startups, and the younger you are, the faster you're going to grow, the higher your growth number. You have a small revenue base, and year 6 for nearly every company out there is going to be better growth rate than year 8 or 9. So I think adjusting the age of the company is really important when you're trying to do an apples to apples comparison. So I'll just throw that one out there because that's been top of mind. Yeah.
So, the concept here is you've got a company like even if you took a second year startup that had hit $1 million in revenue and they grew 300% and they hit 3 million the next year, it's only 2 incremental million. Whereas a company doing $1 billion growing 20% a year, now they're putting $200 million into, if they were at $1 billion in revenue, $200 million. It gets harder and harder to clear that hurdle as time goes on, correct?
Correct. And Snowflake in year 8 or 9, I'm going to just say it will probably be, number 6, 7, or 8 as far as like the top growing tech company on the markets. CrowdStrike is still very high up there for its 8th year and 9th year. If you adjust it for its 6th year, it grew faster than Snowflake. So did Zoom Video. I think Slack did as well. So there's quite a few of them that if you were to adjust it to what was their growth rate in the 6th year, they were higher than even Snowflake. So I think that's really important because when you're around a lot of startups, you know that piece. And I don't think the public markets are fully aware of that.
So Alex, when we look at Slack, which
Sure.
was at $800 million in revenue, they're doing about $200 billion a quarter. They were growing 50-60% year over year, which is a pretty great growth rate. But
Yep.
they sold for $27 billion. So
27.7, yeah.
Yeah, so we're talking about almost 30 times revenue again. Seems like this 30x top line is becoming a number for some reason. Maybe it's the breaking point or it's the upward bounds. What do you take from them selling now? If they've got a business that's growing 50%, why not continue to grow, try to be like Zoom and try to own this platform and maybe even acquire other companies? Why be acquired?
It's hard to read Stuart, the CEO's heart on this. I'll just say that what Zoom has done, I think, is the edge case. I don't think most companies could accelerate as much as Zoom has and be as operationally excellent as Zoom has. So I don't want to say if Zoom succeeded, why did Slack fail to stay independent? Because Microsoft is coming after both of them. But I think Microsoft is coming after Slack a bit more directly. Now, Microsoft Teams, the competing product to Slack, does include video chat. So it is kind of going against Zoom a little bit as well as Slack, but I think it's mostly a contra Slack product. And my suspicion is that Microsoft's very deep enterprise sales channels were just presenting an increasing level of friction to Slack and its ability to sell and grow. So if you're Slack, what you want to do is partner up with someone who already has deep enterprise relationships. And I was talking to Sapphire Ventures' Jai Das about this on an interview we were doing. And he said, if you're Slack, even if you're Slack, it's hard to get a CIO to sit down with you. But if you're Salesforce, they already are on all those phones. They know all those people. They can just call them up and get the meeting like that. So maybe you need a big brother, essentially, to help you grow contra Microsoft while Microsoft is coming after you. So I can see it. Stuart is now incredibly wealthy. The company is exited. He gets to relax in Mark Benioff's shadow and grow as fast as he can. I kind of understand from that perspective.
So a little bit of skittishness. Hey, there's too much risk. There's too much.
I'm very
too much headwinds.
I'm hesitant to call Slack in any capacity skittish. I think this must have been a decision based on how can we go to war with the most weapons versus we're going to lose. They've been great. And I've been a Slack user forever and I like the company and the product, but I understand the logic of trying to go to some place that has much deeper enterprise relationships if you want to sell larger seat count deals and also just defend yourself against Microsoft. And
in fact, they only had 87 companies paying over $1 million a year, which
there you go.
That would be pathetic for a Microsoft or Salesforce or Oracle to have like that small a number of the Fortune 500 paying such a pittance for a product that is so, let's face it, transformative to an organization. Beth, what are your thoughts on that, Sal? And how does that go down? Is it top-down pressure from the founder or the board to the founder, or just everybody sitting there going, this price is crazy, we should just take it?
Yeah, I think this year really started to separate Slack and Zoom a little bit. And I think maybe this is where Slack got to thinking like an acquisition would be a good idea. So Zoom jumped from an enterprise company to being also a consumer company with COVID. And that blew open this new addressable market that I'm a Zoom holder. I've been a Zoom bull for a long time. So I just want to put that out there. But Zoom basically has completely blown open their addressable market because they're going across consumers. And then due to the fact that it's Zoom Phone and Zoom web video conferencing, telecoms globally are starting to partner with Zoom now. So Rakuten, Deutsche Telekom. So Slack doesn't really have that mobility across consumer. And as far as getting integrated with very large global corporations on messaging, if you will, that's not likely. Messaging seems to be very localized. And, I would have to look at the numbers, but Zoom, on the other hand, is going global. They're now consumer, which is really the jackpot. All things are consumer, with the exception of Microsoft, which technically was kind of a long time ago, a consumer operating system, if you look at it that way. But in general, what I'm trying to explain here is that Zoom is kind of in a league of its own, where I think Slack was getting surrounded by Microsoft Teams, accelerating enterprise versus enterprise was getting really tough. I actually was wondering if Amazon and AWS was going to start integrating with Slack, because I know that they're a big customer there. I really like, the name of the product escapes me right now, but where enterprises communicate with each other through the messaging system. Slack Connect, I believe, is what they call that. That is really intriguing to me. And I think that's where Salesforce, with the hordes of data that Slack has, it could be a very decent.
Yeah, that's going to be a huge win. Those cross organization rooms have become super dynamic for me. I mean, we have a couple of boards now that we'll just start a room for a board of a company and then invite that company and invite the other board members. And then all of a sudden we've got this persistent channel to talk about board issues, and it's just sitting right there and it works great. When we get back from this quick break, I want to understand what happens to Zoom post-pandemic, because this seems to be a huge risk factor if it is in fact going as a consumer play, and that's a big part of this. Are consumers going to still pay $15 a month or $180 a year, whatever it is, for a product that they can get for free in Skype and Google Hangouts and many other places when we get back on This Week in Startups? Hey, listen, before you grow your company, you need to know your company. And ChartHop is an organizational management platform that helps companies focus on their most important asset, people. ChartHop's seamless integrations let you collect, organize, and analyze all your people data in one platform. You're going to be able to build an agile, adaptable, and inclusive teams. You're going to automatically create and update your org chart, and that's really the interface. You see your org chart. You can see it over time by sliding a timer. You can see how your organization is going to grow over time. And you can centralize your people data with seamless integrations. No spreadsheets needed, so you can scale your company with transparency and intention. Here's a quick demo for those of you watching online. It allows you to visually build out your team so you can spend more time on strategy and less time moving around boxes in PowerPoint, which is meaningless. You can create these compelling visualizations of all your people data, from diversity metrics to compensation to performance reviews, all directly in the org chart. Your people are your greatest asset. I know you hear that all the time. The reason you hear it all the time is because it's true. Twist listeners are going to get $600. That's 6 hundies right there in credits by signing up right now at charthop.com/twist, charthop.com/twist today. 6 hundy is going to cover your first 5 employees on the platform, so you're going to be all set if you're a startup, and then it's just very affordable from that point on. Go ahead and visit charthop.com/twist to build your dream team today. Welcome back to This Week in Startup. Beth Kindig, and Alex Wilhelm are with us. He's Alex. He's got his first name. Beth, somehow you were late to the party. You have Beth_Kindig, Kindig. What is going on? How do you not have @Beth? Who is @Beth on Twitter? I mean,
that's not technology. Yeah.
It's a prerequisite to be on this podcast that you must be in the First Name Club. What is going on?
You could only have like 6 guests then, Jason. I mean, that's going to be a really, really small circle of people. It's like you and I and 3 other people.
Yeah. Veronica Belmont, Ryan.
There we go.
Jack. Yes.
Jack.
We're now going to limit to First Name Club. I also wound up getting Jason on Instagram, and I didn't know that anybody can DM each other on Instagram. And then I found, like, I'm not big in the Instagram game. I'm a 50-year-old like tech dude. I mean, I post my daughters and whatever meat I'm smoking. Like that's my Instagram life. But I just realized I had like thousands of people asking me to buy a Jason on Instagram. And some of them were like famous Jasons, like comedians or whatever. And yeah, it was pretty hilarious. So Zoom gets this incredible tailwind, unexpected, of the pandemic. Every school is a Zoom school. Every party, weddings, dystopian birthday parties, book clubs. But these products are available for free in other places. Zoom somehow beat Google Hangouts and Skype and other free services, which to me is just a real tribute to Eric's, he was at WebEx before this or something.
Cisco.
So, he's got a lot of DNA in this space. He obviously built the best product, but I'm not sure that product's going to be able to hold off free options from people like a Facebook or people like Amazon or whoever else wants to make free versions of this. And every iPhone has FaceTime built into it. So if Apple decided suddenly to make FaceTime cross-platform, I mean, oh my Lord. I mean, I know they wouldn't do that, but I'm putting the idea out there for Tim Cook if he wants to add 100 billion in market cap. I don't know if he needs it. So as a shareholder, what do you think, Beth, about Zoom post-pandemic?
So when you look at consumer behavior, I think they're clearly choosing Zoom. I mean, the numbers couldn't be better. And actually in their earnings reports, accounts over 10 are growing like 400+%. So they're very strong in the paid larger accounts. And then when you look at consumer behavior, it's really hard to change consumer behavior. And I would say, I went through this on Roku for many years as well, because everyone says Google, Amazon, et cetera. And what I would say is look deeply and look deeply at the management team that could take those tech giants on and execute so flawlessly that they came out ahead. Rather than saying, what if that changes? I would say, I'm going to assume that will continue. And so for me, like Google Hangouts, I can't even remember when that was launched. I feel like it was 10 years ago or something. Skype has come and gone. For whatever reason, those aren't the right products. I mean, I know the reason. It's the friction. It's the fact that they want you in a walled garden. So Google and Microsoft, they want to trap you in. You got to download their software. You got to give them your emails and set up an account, et cetera, et cetera. And that's not what people want. People want to just click a link, boom, I'm in, and I don't want to be part of a walled garden. And Zoom doesn't need you to be part of a walled garden because they don't really have, extra products that data and that PII is going to be informative for. So to me, I think Zoom is executed really well, and I am on the side of I will assume that will continue because I think that leadership did a great job already.
What if there are a large number of unsubscribes when people go back to school in September and you see some churn like that? How would the market interpret that?
Yeah, I think that there could be. It's actually interesting because in their last earnings report, we did have some shelter in place let up. In Q3, it wasn't nearly as strong of a shelter in place, and they said their churn was much lower than they expected. So we're not seeing on the granular level any evidence that Zoom's position is being challenged, depending on shelter in place orders and things like that. And then it's that higher level international expansion that I think is really going to hedge them, is they're already being adopted by these telecoms. And I think that where cloud and the telecoms come together is a really interesting space. And because as you drive around, like we don't actually need hardwired phones ever anymore at all. We can completely run phone through the cloud. So telecoms are aware of that. And I think they're starting to partner with Zoom to make that a seamless integration.
Alex, what's your long-term concerns in a post-pandemic world? Because if we look at the vaccine numbers, 40, 50, 60 million is the current trajectory for December, January, February.
Yep. Probably
conservatively 75 million Americans have had COVID. And if you add those two shots, that's another 60, 70 million. You're already at 150 out of 330 million Americans, of which would be all the high risk and frontline workers. Plus, there might be some built-in immunity for another 20 to 50 million Americans. By March 1st, more than 50% of the country is going to be through this, which means spreading is going to be really hard if people are wearing masks and going out. And so we're going to see the numbers plummet. I predict March 1st, we will see the number of cases and deaths absolutely just drop off a cliff. We'll hit 200 deaths a day. I believe in March. You can clip this and remind me. But I think shame me later. Well, I think it could have been. Sadly, we were under 200 deaths for some days in August, I believe, yes. And we just refused to wear masks like idiots, and people went YOLO because they just don't understand science. But if we get down to under 200 deaths a day, and it's 90% old people who haven't gotten the vaccine, this is going to be over. I think April 1st. Some people debate, summer or next year. What about DoorDash's surge and Zoom's surge? Do you think that those stocks are going to get meaningfully clipped in terms of revenue? And then how would the market react to that? Or are they going to figure out other things to do and, they'll be stable?
Yeah, I think I'm a bit more bullish on Zoom than DoorDash in that context. And just to be clear, just because Beth has been disclosing, all my money is in very boring index funds, so I have no position in any of these companies we're talking about. Just
Vanguard, super low, Wealthfront.
Actually, Fidelity, zero cost, so even lower than low. I paid nothing. Ha ha ha.
I love it.
that's because I don't think I'm smarter than the market. I aspire to Beth's confidence and ability to find trends. I'm much more behind the curve, sadly.
Well, no, Beth, I mean, on that note, if you're not an active manager who is spending 40 hours a week or 20 hours a week minimum managing a portfolio, Alex is doing the right thing, right?
Yes. We actually have a larger team. So there's 2 finance guys on my team. It's not just myself. And so we take it really seriously.
Yeah.
But for somebody who is even a civilian, but who works in tech journalism, you're much better off just being in a low cost index fund or a no cost index fund.
We're killing it right now. We're actually going to come out with our results, and they're getting voluntarily audited out of a place in San Francisco. So we think it was somewhat of a football team where everyone had a specialty and they came together to share it. So we are absolutely beating index funds in the market. Except for ARK. we're trailing ARK. We're trailing ARK Innovation ETF. So
okay, but answering Jason's question about Zoom and DoorDash. So the reason why I'm more bullish on Zoom is my family has had a chat on Zoom on Sundays every single week. Since the start of the pandemic, and we don't use a personal paid account. We use my wife's work account. Hopefully saying that won't get her in trouble. And so I think a lot of the consumer behavior is going to stay because my parents aren't going to move 3,000 miles closer to me. I think there's a lot of this behavior that we've picked up is going to stick. Now with DoorDash, on the other hand, though, there's a really great substitute for this. I can, instead of paying DoorDash a bunch of money to order food, I can go outside. And I think there's going to be a lot of that, not just because we've all been locked in and we're pent up to go out, but because going to a restaurant's lovely. I want to get out of my house. I've been in there so much. I don't want to eat more dinner on the couch in front of the television. But Zoom, on the other hand, makes my life bigger. I'm not going to get rid of that. I'm not going to get rid of the connections it brings me. And I think Beth's point about the growth in accounts of 10 or greater is like the key metric to watch for them, because if that keeps growing, they have a lot of, I think, built-in later growth because those accounts will continue to grow, back to our net dollar retention argument from earlier in the show. So I'm optimistic about Zoom. Also, Eric, the CEO, is brilliant, and I think they have the right customer first perspective. DoorDash, I mean, I can't knock it because it had a great year, but I'm less certain that people are going to keep paying that much for dinner when they can go down the street.
Yeah, I mean, there's going to be a YOLO roaring 20s like we've never seen in our lifetime. You agree with that, Beth? People are going to just go out to whatever remaining restaurants are still open. Whoever makes it to the other side it's going to be hard to get a reservation in the summer. Let's put it that way. Every hotel, every flight to Europe, it's going to be bonkers.
Yeah, I'll be going out just to support the restaurants. I mean, I want these restaurants to stay in business. So I'll just do it even for that, let alone the fact that it'd be nice to get out of the house.
Also, Zoom, it would seem to me, is underpriced in the enterprise. They're super cheap for an enterprise product. If you look at how much we're using it, everybody's using it for at least 10 hours a week, 20 hours a week. So that means every month you're using it 40, 50, maybe 100 hours a month on Zoom, and you're paying $15. I mean, the
gross margins are good. So they can afford to sell it cheaply. I mean, how can you compete with rock solid and cheap? I mean, Google Meet didn't take off because it's not as consistent. Skype was inconsistent. I mean, the secret sauce for Zoom is that it just works every time. I never load Zoom and wonder. I always know, and
once in a while you'll get somebody who will have their audio. They'll be on Wi-Fi. It's like these people who are on like Wi-Fi from their router's 10 years old and they never set it up and they don't take any responsibility for their Ethernet cables or anything like that. Beth, you think they could charge more, correct?
I do. And the management had a great comment in the last earnings call where they said, we choose to give away free accounts because we don't have to spend on sales and marketing that way. So, you can look at the gross margins, you can look at the operating margins, but this company is extremely profitable too. As far as tech growth goes, that bottom line number is very, very impressive. And it grew like 900% this year. So the EPS and the profitability. So I think their operating margins are around 20%, if I remember right. I'd have to look at that up. But I know that as far as their peers in cloud software, their top line is good and strong, and their bottom line is too. So that's pretty rare.
All right. Here's a quick question before we go to break. Think about it. If Zoom doubled their prices and added some persistent chat, like a new feature, like basically build in Slack, which is the obvious next thing for them to do, is you leave your Zoom open the whole time and there's just folders and you can click any one of those folders and that equals a group of people who go on a call. They add that feature, they double their price. I want to know how many customers you think they lose when they double the price when we get back on This Week in Startups. 2020 has proven to be a year of many things, and 2021 is the year you are going to switch to a better payroll program, and Gusto is the way to do that. Gusto wasn't just built for small businesses, it was built for the people behind them, and their online payroll is so easy to use. We use it. It can automatically calculate your paychecks and file all of your payroll taxes. 3 out of 4 customers say they run payroll in 10 minutes or less, which means you'll have more time to run your business. Heidi, who runs HR here at Launch, says Gusto frees her up to do more business-critical tasks like running our syndicate, as an example. Plus, they offer unlimited payrolls for one monthly price. There's no hidden fees, and Gusto can also help with time tracking, health insurance, 401ks, onboarding, commuter benefits, offer letters, and of course, they provide access to HR experts and have tremendous customer support. If you're moving from one provider to another, they can transfer all your data for you, and it's no surprise that 94% of customers are likely to recommend Gusto. Here's the best part. Because you're a Twist listener, you'll get 3 months totally free. That's right. Twist listeners, 3 months free. Just go to gusto.com/twist, gusto.com/twist. Again, that's gusto.com/twist. I'm telling you, you're going to love it. Get started today, right now, by going to gusto.com/twist. Welcome back to This Week in Startups. We're chopping up all the tech news with Alex and Beth. And when we went to commercial, Zoom seems to have a clear path to incorporating a Slack-like feature. We could have a, Alex, for your family gathering, why isn't there a folder on the right-hand side of Zoom and you leave Zoom open all day? And when you click that folder, everybody gets a call. And then you have your Wednesday meeting or your morning editorial meeting at TechCrunch. Or Beth, you have your, end of day meeting with your investment team. They could very easily add a Slack-like functionality. They could do it in their sleep, Eric. And I have to say, I'm very impressed with Eric because I was super critical of them rooting people's devices and running the videos in some cases through China and using a bunch of Chinese developers. And I was like, I would never use this software when it first came out. The Chinese are obviously spying on everybody. If you have servers in China, Chinese Xi Jinping's got the keys. So, and he anyway, I'll leave it at contact was made with me to explain that these things were going to change very quickly. And he did respond quickly. But my question, Beth, if they added these Slack-like features and they doubled the price, what would happen? How many customers would they lose, if any? What percentage of customers would they lose?
Yeah, it kind of reminds me of the Netflix question, which was I remember when it was $5 and then it was $10 and now it's 15. And I think when you have this kind of traction and this level of product market fit, that when the time is right, I don't think the time is right now, but I think that they could increase their prices. What I really like what Zoom's doing too is Pinterest is starting to integrate with Zoom for creative hobbyist demonstration. So, if you're on Pinterest and you're a fashion designer or something, you would integrate, they're integrated with Zoom and they're going to hold fashion classes or fashion presentations. So I think Zoom actually has that developer flywheel where what is everyone else going to do with Zoom in their apps? And that's something that I'm really keen on.
The API.
Yeah, through the API, yeah.
All right. So if they did double it, let's just say they went crazy and they decide to double it in, January 1st, they double the price, in 3 weeks, they double the price. What percentage of users do you think they lose?
I think they'd keep the majority of them. I don't think people are going to leave Zoom.
Yeah.
Exactly.
Yeah, that's where I'm at. I took the long way, but that's what
What do you think, Alex?
15%.
15%. Yeah, I would agree.
Think about it this way. We all use some streaming music service. I'm a Spotify user and have been for a million years. They charge me something stupid, like $10 a month.
You don't know, do you?
Well, no.
See, I mean, this is how cheap these services are. When you don't even remember, I have the family plan for Spotify, which is I think $15 a month. And I just gave it to my brothers, my mom, and I think 2 of them used it. But I'm like, this is such a ridiculous deal. I used to buy 20 CDs a year for $20 each. And this is $180. My whole family gets all music all the time.
Yeah. So if they raised that, if they said, now, Alex, it's now $40 a month, I would be like, well, that sucks. All right. I wouldn't even blink twice about it. That to me is a non-negotiable service. I will pay anything Spotify asks of me. And I wonder how close Zoom is getting to that point, because Netflix has become like electricity in a house. You have to have it. Back to Beth's point. So I wonder if Zoom has reached that threshold, and if so, how much defense that'll give them. But I think it's going to be a lot. I think there's a lot of pricing power.
Crazy in that product. How long have you been on Amazon Prime, Alex?
Oh, I mean, I can't recall not being on it. So, I mean, ages.
Year one. Do you remember what you paid year one?
I don't know what I'm paying now.
Introductory price.
How much does it cost?
You don't know what you paid originally, and you don't know what you pay now. Beth, how long have you been on Amazon Prime? I love this.
I think about 4 years. I want to say it's $99 a year.
Do you remember your first price you paid?
I feel like it was $99 a year. Yeah.
Okay. The introductory price was $50 to $60, and it's $150 a year now.
Okay.
And the reason none of us actually even know what we pay for it is because it is such tremendous value that who would ever not have 2-day delivery? They've boiled the frog, right? And I wonder about DoorDash to the discussion we're having here is, does DoorDash have that same thing where I kind of feel like the pricing on DoorDash and even Uber Eats and some of these things, I do hear people who are affluent saying, well, it's kind of expensive. Maybe I should go pick it up.
I mean, that was us last night. We were running late for dinner and I didn't want to cook, and I had book club with my dad, and Liza had a thing. And I was like, I'm just gonna order Indian food. And it was it was supposed to be like $50 or $60 for us both to eat Indian food in our house. And I was like, okay, but maybe we don't need that. It just felt to me like all of a sudden it was like 20% more money than I wanted to spend on dinner because I was going to eat it at home on the couch in front of the TV where I always am.
What about you, Beth? Have you had that? Listen, we have people on the call right now who are not price sensitive for the extra $20 it costs to have dinner brought to the house, but they've actually kind of charged what the real cost is, right? And the real cost is not de minimis. Do you even think about the cost now, Beth?
I'm kind of in the same boat where even like my OTT connected TV, like I have so many apps that I'm paying for. I think I'm paying more than I used to for cable. Amazon Prime, Netflix. But when it comes to DoorDash, for some reason, I always look at that price and I'm like, that doesn't feel right. We actually pick up a lot. So because of that, it's like, I don't mind tipping the driver and I want the driver to be paid well, but it feels like there's extra junk fees in there that I'd rather not pay $20 for delivery. So yeah, I'm kind of in that camp.
I am not price sensitive, but I do look at those numbers sometimes and I'm like, and you know what I realized? I had somebody on the podcast who Chow Now, and they provide enterprise software to restaurants, and they charge like $500 a month or something. So if you're a restaurant and you want to basically have the software of Uber Eats or DoorDash, you can have that, but you have to bring your own delivery service, right? And what I realized when I started doing the back of the envelope math, because I grew up in the restaurant business, do you know what delivery people were getting paid prior to DoorDash and Uber Eats and Grubhub? They were getting paid like $20 a shift for a 12-hour shift off the books. They were typically illegal immigrants who were being taken advantage of. They would be given $10 or $20 in cash, and then they would get $1 or $2 a delivery, and they would get whatever tips they had. So they would probably net out to $5 to $10 an hour off the books, or if it was a slow night, they might only go home with $25. That's kind of how the industry worked. So you had this underground economy that was subsidizing food delivery. And now you have these companies have to do it by the books. And even doing it by the books with gig workers, it's really expensive to do.
Shows up. I mean, whenever you finish clicking the food items and then the actual bill comes up in like Uber Eats, for example, which is what I use, there's like more lines than I expect. And I feel vaguely annoyed by that, especially because I know there's markup built into the food prices because I'm ordering from restaurants I used to go to. And I'm like, wait a minute, I'm paying every direction here and the restaurant isn't doing that well. And the delivery driver isn't really making mint. I feel like instead I'm kind of just helping the company that's doing the least work. They're not driving the car. They're not making the food. Why is DoorDash worth $60 billion when all the restaurants are closing? And to be clear, the company has arguments about why this is not as bad as I'm making it out to be. But like that song plays in my head consistently when I execute these transactions.
All right, let's look at some of the bets that you're making, Beth, that you think might be sleepers or undervalued in this crazy market. FuboTV, first I'm hearing about this. Sports betting integration, founded in 2015. Q3 revenue, $61 million, 47% increase year over year. So they're on this like $200 million run rate, $2 billion market cap. That's only 10 times their run rate.
Yeah, and their forward is actually, forward revenue growth is 70% next year. So they're guiding for that already. What I like about Fubo is, so connected TV and OTT apps, they're actually reaching like a hype the 2021 through 2024 are going to be golden years for, your Roku and those kinds of companies. And Fubo is relatively unknown. And the reason why the majority of the people continue to subscribe to cable is for live sports. And actually, PricewaterhouseCoopers did a study, and 9 out of 10 people who have cable today kept it for sports. And 8 of those, 8 out of 10 would cancel it if they could replace their live sports. These are not like your casual home team, football fans that could just do the fragmented ESPN Plus. So what Fubo does is it aggregates all sports, live streams, and you can get that for about $60 a year. That's really exciting on its own because there's so much statistics and so many trends supporting the live sports audience. But the bigger catalyst is the sports betting. And I really like the backers on this one. You have Disney and you have Sky Media. I was actually a VC scout for Sky Media about 10 years ago. And these guys are great when it comes to sports betting. They're maybe the world's best company when it comes to sports betting. It's a 20 billion market in the UK. So when you're taking those kinds of strong backers and you have that kind of a trend and you have the right ear for it, I think that 2 billion market cap is so low that it's worth a look.
And we now have sports wagering. The Supreme Court said wagering's going to be, what was that, in 2018? They said, hey, sports wagering's legal. States want to do it. They can do it. And lo and behold, the NBA, the league that had been dogged by the most gambling scandals, Donaghy, the referee, and Michael Jordan potentially having to take a year off because of sports betting. And they are embracing it more than anybody, it seems. Like Adam Silver wants to put a team in Vegas, which would have been forbidden in the, just under Stern in the NBA.
I think there's 10 states right now where it's legal. And then other people use VPNs to get around that. But I think over time, it's kind of like some of the other cannabis or some of the other ones that are kind of in limbo between how many states have approved it. But again, I really like the Sky Media backing, and I think that they're the ones to get it done.
Yeah. Any thoughts on this wagering space? Are you seeing a lot of these companies, getting backed? Because we as venture capitalists typically have no wagering in our documents, no drugs, no wagering, no porn.
Mm-hmm.
In terms of what we can invest in.
DraftKings has done well in the market this year. But again, I really like Fubo better because I like the fact that it's also the streaming channel for the live sports. So you'll get that $60 a month, and then you'll have this catalyst for the revenue growth. I like that combo a lot.
Alex, any thoughts on wagering?
I'm surprised, Jason, that you would constrict yourself so heavily with your LP agreements. It sounds like some sort of
no choice
inquisition agreement there. As a bad poker player, I'm a fan of friendly wagering, and I think that Beth's point about Sky is really good because Sky is fantastic. I'm a F1 fan, so I watch a lot of Sky F1, and they're just a tremendous organization. So with her thesis, I would concur. I will say I don't see a lot of startups in my neck of the woods that are working on this. I think because of what you just said, the capital sources that they would usually turn to are pretty dry. That may change in time. I think cannabis is now backable by more groups of people, and I'm sure this will follow in that vein. But currently, it doesn't come up enough for me to have much of a thesis on it, other than I like sports and I like gambling. Yeah,
I mean, basically, it's other jurisdictions now are becoming the funding sources. So if you look at cannabis, all the Canadian, Canada had the national referendum. I happened to be there the week before it happened speaking at some event, and literally people were just throwing edibles and smoking joints everywhere. It was hilarious. But they all went public on the Canadian markets because Canada was like, yeah, we'll take that business. And here we are in America. Only 18 states have legalized sports betting. I'm not sure where we are with the cannabis national referendum. Twilio, man, Jeff's done an amazing job at acquiring companies, SendGrid and Segment. Beth, thoughts on Twilio and their potential as a company? Overvalued, appropriately valued, management?
I think Twilio is going to be a big surprise over the next 5 years. And it's because of the pivot that they've done, which has been somewhat underreported. So they did these acquisitions at SendGrid, Segment. They also have Flex, the contact center, and they're really transitioning from cloud communications and APIs over to becoming a data company. And I believe, in my opinion, they're doing it just in time as things become more decentralized towards the edge. Twilio being on edge devices and being that close to the customer as a touch point is really nice positioning for them as edge computing starts to be built out. So I think the Twilio that we knew over the last 10 years, that's a great start. And I think COVID really helped them. But I think the Twilio over the next 10 years is going to look very different. And I love a pivot when you go from having that strong foundation over to leveraging the data that you can control and is the first party data. And they're basically saying like, hey, rather than have centralized data management platforms, which Adobe, Oracle offer, why not get closer to your customer, get in their inbox, get on the contact center or whatever AI bot you have serving them, and run some data and really figure out how to market them and create publisher segments and increase your ROI. And that to me, like I can just see that vision, and I'm pretty bullish on that right now, especially after the last earnings call where they really pieced it together, which was this omni-channel marketing play.
So in a way, a more technical HubSpot. Or
yes. And more
maybe
yes.
sort of, yeah, exactly. So any thoughts? You've covered Jeff for a long time, Alex. Any thoughts on his performance as a CEO? We saw him as a product-driven CEO and now becoming, I would say, an acquisition empire building. I'll call it empire building. Like he went from product to empire building. Any thoughts on Jeff and that transition he's made?
Yeah, if you all of a sudden have way more money to spend, I mean, the value creation at Twilio has been epic. I mean, the company has done very well since its IPO, and so you have tons of liquid currency to play with. Why not go out there and buy the things you want, create revenue, and as Beth said, build out a much better and bigger product feature? I mean, if you can grow your TAM and accelerate your growth at the same time, huzzah! What I'll say about Jeff, I talked to him a month or two ago at TC. The only concern that I would have is he wrote a book. And I have it. I need to read it. But I always get worried when business people start writing books. What are you doing with your time? Why aren't you doing what you used to be doing? Are you a guru now? Are you Mark Benioff Jr.? Because we already have Mark, and I don't need any more of that. Yeah. I'm sure the book's lovely. I'm sure they're going to keep executing well. But when companies get sufficiently large, which is kind of the point that I'm making.
Like when they build a building, right? Like when you start building like the Apple campus or the Salesforce tower. I see it in startups when they start having arguments over the reception area and like the kitchen. And I'm like, can we get off the kitchen and the reception area and just put up a folding table and get back to the product? Like there's always some moment in the board meeting where the two founders are fighting over the lunchroom and the new campus. And I mean, it's a little bit of a tell.
Apple built that enormous spaceship campus down in Cupertino, and then they launched $550 headphones. So obviously it's worked out incredibly well for them because that's the most brilliant product choice I've ever heard in my entire life. That was sarcasm, by the way.
Yes, it was dripping. Do you think when we see the most, the M1 chip, is it M1, the one they put in the new chip? I mean, that does seem to be a really good sign that they understand the flaws in the desktop product line, which is it crashes, spinning wheel of death. But then you see like these like silly things like $550 headphones, and you're just like, what are they doing over there? Are they just trying to wring every ounce of margin? And where's the new innovative product? Where's the AR glasses? Like,
I think the M1
are you worried about them?
No, I think the M1 is sufficiently interesting that it's going to change things up. I mean, I'm on a MacBook Pro right now. I have gaming PCs as well because I'm a dork. But I mean, like the M1's the first chip that's come out in time immemorial for me that I've actually wanted to go buy a machine just to use because it is that efficient and that interesting. So I think all the headphones and all the jokes we made about how many pairs of AirPods we've all bought over the last couple of years is what funded that. So they've taken that cash flow and put it to good use. Now, there needs to be an M2 and an M3, and it needs to be as impressive. And maybe Intel will stop being Intel for 5-10 years, kind of get back on track. I'm not optimistic about that personally, but no, I think Apple's going to be great. But back to Twilio, because I've derailed us. I'm sorry. I concur with Beth's generally bullish take on the company, given the history and the business plan. I think it's good.
All right. Tell us what C3.ai is, Beth. First time hearing of this company.
It's enterprise AI, and they work with a lot of the verticals that I think are really interesting, manufacturing, oil and energy. My understanding is they're just using AI software to make those industries function more efficiently. The founder, I believe, is from Oracle, right, Alex?
Yeah, Tom Siebel.
Tom Siebel, he's from Oracle.
Tom Siebel, exactly. Yeah.
Yeah. So, a lot of people really follow Tom Siebel as, they think that is really strong backer. I like them a lot because we've been covering AI, and the AI economy is just, it's going to be so large that it's almost hard for us to imagine. We have a target number of about 4 times larger than mobile. And mobile brought us, Apple, Google, Facebook, et cetera. So if you think about the native apps and all that. So we are looking for a lot of AI entries right now.
And if we look at this company, $41 million in their most recent quarter, $165 million run rate, $12 billion market cap. So playing our fun little game here in terms of multiples. It's a pretty juicy multiple. It's
a very juicy multiple. It's second to Snowflake, I think. And I believe both Snowflake and C3 are valuations we have literally never seen before in the markets.
But it's on a small revenue number, so growing into it would not be as hard. Is that your thesis, Beth?
This one's lumpy because I think it was the last quarter they only had 16% growth, but in the past they've had up to 70. It's just really lumpy. It's newer, but I'm mainly investing in the product at that point.
Do you, Beth, feel good about SPACs and companies getting public earlier? Or do you think there's an inventory problem vis-a-vis Nicola, Fisker, and a bunch of people who are obviously unqualified to run businesses?
We entered one SPAC so far, which was Luminar. It was a flyer. It broke all of our rules. And we went ahead and did it because on my team, I have a technical analyst that will get us back out quickly if the market turns on it. But overall, I would say I stay away from them. It goes back to kind of that beginning comment that the majority of super legitimate, long-standing startups and tech companies that go public tend to trade below their opening price 6 months later. I think these SPACs are going to follow minimum that similar trend, keyword being minimum. So, we don't like to see a lot of loose rules for public markets, and the SPACs have found an interesting loophole. There's a lot of inventory on the market. We have been very conservative with the exception of Luminar.
That's the LiDAR company, correct?
Yes, that's the LiDAR company.
And the idea there is they will be selling to the, self-driving car companies of the world, or for smartphones and gadgets, or both?
Autonomous vehicles mainly. They're partnered with Mobileye. If Mobileye was a pure play, I would actually invest in them. They come with Intel though, so not investing in Intel. But Mobileye is the ADAS system. They use cameras. They're going to create redundancy and team up with LiDAR and run both so that it's very safe on a redundancy level. I think Elon Musk has had his debate about this, and they're saying there's no debate. We're going to use both so that this vehicle is just very safe. I like that partnership with Mobileye. I like the Volvo and Daimler partnership. But of all of the entries we've done, that is probably the most speculative one just because it's almost pre-revenue. I think they had about 18 million in revenue in 2019. So I think that if you're going to get into SPACs, if you're going to do this, you should be doing it daily and you should be experienced, basically.
This is not for the casual investor.
Right.
And the quality seems incredibly highly variable. And when you look, Alex, at the promoters, for every person who's a Chamath or a Reid Hoffman or Mark Pincus, people who we know have and have built actual companies, right, and who know what they're doing, it seems to me that every retired person, ex-celebrity, or somebody with a waning following,
sure,
and nothing to do living in Miami Beach or some other tax jurisdiction or a place where you can't have your home taken from you because of the domicile laws. That's when I get a little worried. There's some weird promoters out there promoting this stuff, and I think the inventory is suspect. What do you think, Alex?
Yeah, I mean, SPACs are just ICOs for the public markets. And, when I was learning about all this stuff, they were called blank check companies, and they were used to float trash. So, I'm not shocked that we're seeing Nicola, which went up because idiots bought it, and it's going down because it was always run by dorks. I mean, my God, what are we doing? The public markets are super frothy. You can do a lot of fun things in them today. But, mostly the companies that even I've heard of that are going public via SPACs are not that great. Metromile in the insurtech space, if you look at its year-over-year revenue, it's down sharply. If you look at Opendoor, which is going public via SPAC, its numbers aren't super enticing. These are just second-rate companies going out via
or young
formerly
companies.
Exotic methods.
Or young companies, I think in some of those cases, like We'll see.
Why? There's so much money in IPOs right now. Why wouldn't you just go public? We just spent 20 minutes at the top of this show explaining how much demand there is for IPO shares. There is a ludicrous amount of demand for them. Everyone's raising their range, pricing above it, and exploding. If that's not attractive to you, you're probably not ready to go out because everyone's managing to do well. Like C3.ai is up like 150%. And this is the first time I've disagreed with Beth all show. The revenue's been flat for 3 sequential quarters. And I know it's up 17% year over year, but like it's been really flat for a while. I was surprised to see it do what it did, given how many times it's turned in $41 million in revenue.
Beth, any thoughts?
Yeah, I think it's just really looking into the future on enterprise AI software, and it's overall. I think that I completely agree with you, Alex. If you look only at the fundamentals, the trailing, that makes absolutely no sense. We have been wanting to get into the enterprise application layer for a long time, and we think this could be it. So we are investing in the trend, and like I said, it does require watching the market very, very closely, which I don't do. That's what my partners do. So with that one, especially, I think that again, you have to be somewhat experienced to be watching the market.
For sure, okay. I understand your thesis, but from the way that I look at the market, it doesn't make a lot of sense. But from that end, I get it. I'm really curious about what happens to that company. It's going to be a fascinating kind of like business case, I think, over the next 6 quarters or so. I'm stoked.
And we're going back to the future in a way where retail investors are going to get to participate in companies that are earlier in their product market fit, earlier in their, or more probably accurately, their predictable revenue phase, right? So this means more risk, which could mean potentially more reward. Let's talk about, as we wrap here, 2021, what top IPOs are you most intrigued by and or tracking, Beth?
I really, really like UiPath. I think it's coming public in the first half of the market. It's made a lot of the top lists for top growing companies. Deloitte had it up there as number 1, I think, in 2019. It's joined Snowflake on Forbes. It's on Financial Times. It grew about 400% over the last 2 years. So that's combined 2 years. And it is automation processing software, so kind of robotics automation. So it gets rid of the menial tasks of loan processing or accounting or receivables, things like that. And it basically gets rid of some of that redundancy in certain positions. And the Fortune 500 has really embraced that company.
And your number 2?
Well, I guess I'll comment on Roblox. We're not entirely sure we're going to enter, but what I like about Roblox is the age group that you can get some exposure to in your portfolio. So it's the under 13. Snap has that going for it, which is how do you get exposure to that age group without Snap? And the one thing I guess, Roblox has had, I think 90%, year over year revenue in the most recent quarter. Gaming, though, I think you can ride that wave a little bit, but obviously kids are going to go back to school. And I think they really are going to go back to school. I think you could argue that some office workers may go into more of a hybrid mode. But and I've been through boom and bust before with gaming. When I first got started, Zynga was the big company, Gree out of Japan, Supercell, and it was a boom bust cycle. A pretty heavy boom bust cycle. So I guess if you're going to ride that wave, you got to be prepared to get off whenever it's time. But yeah, I think Roblox is one that has a lot of traction. That audience seems to really like that the gaming.
It's the nature of a hit-based business, correct? Like
yes.
It's very hard unless you have such a massive portfolio like EA or in the IP space, Disney with Marvel and Star Wars and Disney and Pixar. You really need to have a wide enough collection of assets that when Star Wars, falls out of favor, Marvel picks up for it or vice versa. And then your third?
Boy, I can't think of a third right now. I mean, in general, we actually try not to enter IPOs until the lockup period has expired.
Got it.
For what it's worth. Yeah.
Alex, what are you looking at?
Well, I wanted to say UiPath, but I did my homework for the show second. So Beth got first crack at
All
the
right,
apple.
so that's okay to have a look. What do you like about UiPath?
I like it in the short term.
We like consensus.
because it's such an amazingly quickly growing company. Robotic process automation, or RPA, is something that I didn't fully grok until it had already become a thing. And so I've been super impressed with the company's ability to execute and expand revenue across a large swath of enterprise companies. What I'm concerned about longer term is RPA becoming commoditized and baked into other platforms that can offer it essentially as part of a bundle. But in the short term, it's a company that's executing amazingly well, and that kind of growth, just because of what we've seen this year with how investors treat growth, it's going to be very attractive to people that like to get into IPOs. So that's why I think it's going to be a hype offering, and I'm looking forward to writing about it.
Okay, and then what is your number one after that?
Stripe, for sure. Stripe. People said that it might raise money at like $100 billion valuation.
Crazy.
Yeah, but I mean, like, they're doing hundreds of billions of dollars a year in processing, 2.9% plus 10 cents, whatever. And they just announced an entire suite of banking as a service products, which other people can use to plug into their platforms. So they just greatly increased their TAM by doing that. And they were already huge and growing and doing well. And what I hear from the edges is that it's currently relatively well run. So growth, scale, product expansion. I mean, it's hard to hate on it. And sure, it's expensive. I don't think it's going to be a cheap stock. But like, if I was picking a company to fall in love with, pre S1, I think this might be it.
And you also had Didi on your list, the Uber of China, which does Uber still own their 17% of Didi? I'm not sure.
I think so. I think they still have that stake. The reason why I put Didi in there is because I think they're expanding into groceries. And I think we've seen grocery delivery have better economics than we expected. And given the mass scale that's possible across Didi's network in China, it could be an attractive play. I would want to see the numbers before I told any of my friends to buy a share. Not that I would do that anyways, but like I'm just very, very curious about that one. And so when we do get the numbers, it's going to be a fascinating read. And
it looks like in September, Uber was pursuing a partial sale of its $6 billion stake in Didi, which was at 15.4% when Uber obviously decided that they didn't want to go into a never-ending war in China, an authoritarian company that picks the winner of the war.
Yeah, it just feels like a different era. I mean, remember when Didi and Uber was like a hot thing and the Chinese venture capital market was the biggest story in the world back in like late 17, early 18? I mean, it's funny how much things have matured, slowed down, and seem to like almost ossified since then. Fewer new players at the top end, and I don't know.
I gotta think different. That people are after what happened to Alibaba and because the IPO was pulled. Right?
The Ant Financial IPO.
Ant Financial, yeah.
The Ant Financial, rather, yeah. So what happens now with that? And then how do people look at the Chinese market, Beth, do you think? I mean, would you want to place bets in a market that's kind of run by a king?
It's tough because we've had, geopolitical tensions with China for about 2 or 3 years. So I think if you stay out of the China market, you could miss a lot of opportunities. We actually own Baba. We were waiting for Ant Financial. We covered it for our site in August. And so we were pretty disappointed when they pulled it because, this, what does Alibaba own? Like 30% of that company? I can't remember what the windfall is, but it's substantial. And Ant Financial as a product, I don't think you could have a more successful product. Every human in China uses Ant Financial to the point where they won't even accept cash over Ant Financial, Alipay and whatnot. So to us that was worth the shot, and we're still in Baba, but we actually just initiated in another Chinese company. NEO is a great stock out of China this year. So it's tough because I can see a lot of people say it's too risky, but on the other hand, there's been some decent gains. So
you think it's going to geopolitically get cleaned up with Biden? Pete Buttigieg, they're saying, is going to possibly be the ambassador there. Do you think they'll take a moderate or engagement stance, or do you think they're going to be pushed to kind of put their foot down about democracy vis-a-vis Hong Kong and Taiwan?
I would like to see us be strong with China because, I really like the fact we moved Taiwan Semiconductors out of, we're moving them over to Arizona because we need more manufacturing from the semiconductor foundries and whatnot in this country, because that is what AI and 5G are going to be run on. And in general, China cannot have our best interest in mind, and we cannot have China's best interest in mind if one of us is going to be the bigger economy. It's going to be run on AI and 5G. And so I think I would like to see us have a strong stance myself. So that
Alex, we are seeing a generation that kind of doesn't believe in capitalism or is anti-capitalism or feels capitalism needs to be constrained, broken up, et cetera, et cetera. And now we've got this competitor in China, as Beth is saying, the war we face is not going to be one fought in all likelihood with tanks and submarines, but AI chips and 5G routers and towers. So what is your take on capitalism in America and our chance of winning the economic war with China?
This is why I love this show, and that's why I keep coming on. It's like, we're going to talk about tech stocks, and it's like, now explain American democracy to me and how capitalism will work. But great question. I think a lot about this.
Yes.
Here's my take. So I think capitalism in America is totally fine. And if you're worried about that, you are an idiot. We may see 2 or 3 percentage points higher on the top marginal tax rate. If that's your definition of socialism, go look up what it means and then get back to me.
Yes.
Now, on the China front, they're making a series of mistakes. They are antagonizing every partner that they need regionally and also in terms of trade. So Australia and India are great examples of this rising tension. And inside of China, you cannot be at all critical of anything that's happening. And that's what the founder of Alibaba ran into, Jack Ma, with the Ant Financial IPO. If you dug into what happened, he gave a speech and was very gently critical of certain elements of the financial regulatory regime and how it pointed the country towards the future. And that was enough for Xi Jinping to yank the entire IPO. That means there's...
Which is crazy.
Yeah. It was already sold all the shares. It was going to raise like $30 billion, something crazy like that. It was going to be a blockbuster event for the country and for capitalism inside of China. Instead, they turned it into a symbol that one person is in charge and only one person's view matters. That is not how you run a successful economy. So if you want to think about the competitiveness of the Chinese economy versus the US economy, there's going to be the US, which will be largely unchanged because of the power of corporate interests inside of Congress, or China, which is run by Xi.
Right.
I know where I place my bet. Now, we got to get Trump out of the White House and we got to get rid of the crypto fascists in our government. But I think we'll pull it off in January, and I'm very bullish on America. And I think the fear that Jason and I say this with affection that the older generations have in this country of the Gen Z folks being socialists, if they're really concerned about that, they could go about doing things like raising the minimum wage and allowing for universal health care in this country, like every other damn industrialized nation. We don't have to live in the Stone Age.
That would be a nice negotiating position. I agree, and I've been tweeting about this like. $15 an hour. I mean, Amazon went to 15, Walmart went to 11 or 12, and McDonald's stopped fighting minimum wage increases. And they're not pro minimum wage increases, but at least McDonald's stopped fighting it. Beth, let's talk big picture geopolitical. You've heard Alex's position on it. Do you think China, who's got a better capitalistic run at this war? America or China? Is there an edge? And if you were to give the edge on a percentage basis, would you make it 60-40 which way or the other, 70-30 which way or the other? And we'll end on that. The percentage we think of who's going to win. I'm going to lay my odds as well.
I'm going to go 95% America. And it's because, it's because we have the technology. I mean, we are leading and we continue to lead and they follow. So they are a strong follower. They can definitely rip us off and create the same technology that we created, but we're leading. NVIDIA, for instance, is a gem. It's a gem for this country. Their chips are super powerful. They accelerate AI, and AMD is also a gem. I just think that even Qualcomm, right? I mean, Qualcomm's in every single 5G smartphone, and Huawei is dying to get.
What do we need to fix to ensure that we win? Are there things in this country that we need to fix? Yeah,
I think we need to bring any kind of manufacturing that is in regards to technology needs to come back overseas. Yeah, hopefully Apple, you're hearing this. And I think it can come back over, into our country and this side of the world with robots. I mean, that's the whole thing for me is like, we don't need to offshore manufacturing when we can use robots here and people can have great jobs and, automate this process. So
100%. And even if the manufacturing just becomes less dependent on China and we put it in Vietnam, India, Pakistan, Sri Lanka, Philippines, and any other number of places, which Japan is actually subsidizing their companies. They're giving them incentives to get out of China before this whole mess blows up. I think we are 80-20 versus China. I'm not as bullish as you, Beth, because I do think if we were to have a highly socialist, liberal Elizabeth Warren type or Bernie Sanders type make it to the White House, which I don't think they will. But if we were to go on that side, I do think that there could be such an anti-corporate conglomerate movement like we see with the AGs trying to fight Facebook in the rearview mirror, that it could cause us to lose a little bit of our entrepreneurial edge. But I do think there's a significant chance of civil unrest and civil war inside of China. And when I say significant, I mean low single-digit percentage. But man, the outcome of a civil war like we saw in Hong Kong, you talk about millions of people getting in the streets. What if tens of millions of people in the streets of China just say, enough of this bullshit? We're not going to be told what we want to do anymore. And, you can only run over so many people with tanks, as they learned in Tiananmen Square, and you cannot run over 10 million people. I mean, this could become chaos in their own country. And I think that's the risk factor for the planet is, we have to steer China towards at least some form of basic human rights in terms of Uyghurs and people being able to access information. And there seem to be our engagement now seems to have enabled their bad behavior. And this certainly this US administration has given the green light to them to behave poorly. Alex, give us your percentage. 95.5 from Beth, 80-20 from JCal.
I think we're doing Price is Right pricing, so I'll go 95.001%.
Okay.
just to pull ahead a little bit.
So we're all feeling really bullish. Explain.
Remember back when it was going to be Japan that was going to take over the US? This actually predates me a little bit. So I wasn't actually around for this.
I actually remember it's the 80s. Yeah. They bought Sony, Columbia Records, Rockefeller Center.
Right.
And they started buying all the real estate in Hawaii.
I was only here for half of a year of the 80s, but it was a great half year, I have to say. But I think there's a lot of similar fears here. And if you go back just 2 years in our little world, Jason, of startups and venture capital, people were raving about the 996 that you work like 9 to 9, 6 days a week in China, and how they're going to eat our lunch, they're going to crush us, and et cetera, et cetera, et cetera. Not really. Hasn't really happened, and I think it's going to keep happening. I think rising central government in China, like if you're worried about Elizabeth Warren becoming president and enacting some modest critiques of M&A behavior, think about a country in which you don't have the ability to contest anything. I mean, that's not a business climate that's going to win. Now, China does have a lot more folks than we do, and that's going to lead to, more economic output. I think we're going to lose the GDP war, but I don't think we're going to lose the per capita GDP war and the and what I would call the freedom dividend of having a functional press and the ability to have dissent. And just to throw in one little note, and then I'll shut up. I think what's happening to Hong Kong is catastrophe.
Mm-hmm. Yeah, I mean, we
absolutely.
And Tibet and Xinjiang, and I think the human rights mess here should make you think twice about supporting companies that are supporting that government. And if you're not willing to put your morals where your money is, fuck you. You can
I agree. I mean, look at the NBA. It's like you can't be in the NBA and be, a proponent of Black Lives Matter here and then take Daryl Morey and make him a sacrificial lamb for saying freedom in Hong Kong. You can't have it both ways. Just because, and I was kind of disappointed in some of the NBA leadership where they were like, hey, everybody shut up about China. And it's like, I understand it's 20% of your revenue, but is it worth 20% of your revenue to lose your soul over being able to say people have basic human rights? I would just rather give up the 20%. Give up the 15%. And then you look at movies being made. They're changing the end of movies. You can't have a Chinese villain in a movie anymore because then you can't play in China. And they've banned a number of American actors from their movies ever playing. If you just type in American actors banned in China, you'll see there's a list of people who, and then those, I think Richard Gere is one of them. And Richard Gere's career went down because Hollywood is so in on the take. So you look at the NBA and you look at the Hollywood, two of the most virtual signaling groups in the world. And, they're on the right side of history with those some of that virtue signaling, obviously, but they won't stand up for people in China. It's bullshit. Beth,
I think the people that are making those choices aren't the ones who care about Black Lives Matters. The players consistently in the NBA are showing up, defending their fellow citizens, arguing for racial equality and a crackdown on police violence. Those are not the same people that are making choices about China.
LeBron wouldn't say anything about China. They threw Daryl Morey under the bus. I was very disappointed in LeBron.
So to be clear, Jason, absolutely. I just want to make sure that we're putting the onus of blame in that particular situation on the people who own the teams, who are not, by the way.
Yeah, no, I mean, they couldn't bring it up either.
Well,
they basically did a blackout. They just said, listen, nobody can talk about this subject.
If we keep going, it's going to be 20 minutes and people are going to be irked with us that we didn't shut up.
Yeah. Any final thoughts, Beth, as we wrap up?
I agree with everything you guys have said.
Okay.
Yeah.
There you have it, folks. Great job, Beth. Any plugs? Any where we can find you guys? The newsletter is beth.technology, correct?
I have a free newsletter. There's stock tips and stock analysis that comes out for free every week. And then we have a $65 a month premium subscription where you get access to the portfolio and the trades that we're making and really in-depth research. So
love it. And Alex, obviously, everybody go right now and search since you're in your podcast player for the Equity Podcast, and you will hear Alex there. And Alex, you have a Substack. Have you quit TechCrunch to do your Substack newsletter yet?
No, I'm trying to have kids, so the idea of having paternity leave sounds nice. No, I'm on Twitter. I'm at Alex, and say hi. That's it.
Okay, there you have it, folks. We'll see you all next time on This Week in Startups. Bye-bye.